just a bit.
Hello. Sean Brady with another fabulous episode of the Talkin' Money and Financial Education Podcast. I'm back with my buddy Omar Maldonado. Omar, how you doing today?
I'm doing great.
We've been talking money across the board, in and out of different conversations, and you were bringing up insurance. Now, I thought you were a financial advisor.
I am a financial advisor.
You're not an insurance guy.
I am an insurance guy.
Okay, smiling a little bit. I did partially know that, but you were talking about another thing that you wish more people knew about.
Yeah.
And that's where the insurance portion came up.
Yeah, absolutely. A lot of times when people think of financial advisors, they're thinking of what most people do, which is just talk strictly investments. I work more holistically, so I'm licensed also to discuss insurance, and life insurance is such a huge component of protecting people, and also I also look at life insurance not just there, but also retirement planning, retirement income planning, having a whole nother bucket of money that you can take advantage of when we have a dip in the market.
Yes.
All those kinds of things.
Well, one of the things we were talking about earlier that caught my attention, because as most of you guys know and gals out there know, I like to think we have our financial ducks in order. But there was one thing that you shared earlier specifically about giving.
Yeah.
And setting it up in a way where a lot of people, and this surprised me a little bit too, but I never thought about it before because I'm not at an age where I have my minimum required withdrawal. Mm-hmm. What's that actually called?
It's called a required minimum distribution.
Required minimum distribution, thank you. I am not 59 and a half yet.
Right.
But you were sharing some tax advantage ways where people can actually use that money, because a lot of people, if they've saved properly throughout their life, now they're in a giving situation. Share some of the stuff we were talking about, because you can articulate it better than I can.
Yeah. So I work with a lot of people who, they're generous givers. They want to give back. There's, it's been proven that when we give, we have a sense of fulfillment. I mean, we live longer, we live happier lives, right? And there's this thought process that when we give, we're gonna, we can do some insurance, we'll give it to a company, and then we're gonna leave our kids, all our assets. And I say no.
Yeah.
Look, the assets that you have, IRAs, 401ks, all those qualified funds, those things are gonna get taxed when you give it to your kids. So you can have $1 million set up in assets.
Yes.
And when you die, your kids are not gonna get $1 million.
Right.
They're going to get taxed on that. Maybe on average they might get $700,000. Right.
Well, there be an estate tax or whatever.
Right.
Type of tax.
More than likely, what happens many times, it actually goes to them and they get individual income tax.
Oh.
Yeah. So it counts as income tax. Your IRAs, those qualified funds.
Right.
When they comes out, yeah.
So even if they were at a very low income tax bracket, all of a sudden there's this. Probably pretty big spurge. It doesn't even have to be $1 million now.
No,
I mean it could be $180,000.
Yeah, it just they'll have to pull it out, or if they decide to pull it out all at once, then it's a much larger income, which will shove them up into a higher tax bracket.
So the strategy you shared with me, I'll let you explain it again, but that was a neat way to think about it. Instead of taking those distributions and giving out of your checkbook. Right?
Right, exactly.
So these different charities, churches, your whatever you love to give to, what's a nice strategy there?
Yeah, so instead of going to your bank and giving, $1,000, couple thousand, $10,000, or hundreds of thousands, whatever it is, don't do that out of your bank. The way you do it is you can take that out of some qualified funds. Why? Because the nonprofit that receives it, there's no taxes on there. So if you needed to pull out $10,000 because you wanted to give generously to an organization, if you gave $10,000 to your kid and you pulled that from an IRA, for example, you would need to pay taxes on that.
Sure.
Right? So your kid gets maybe $7,000.
Still the same scenario.
Right. However, instead, if you gave that same $10,000 to a nonprofit, a 501c3, they would get the entire $10,000. So I tell people, look, when you're in retirement, do the things that you want to do.
Right.
Join the country clubs, go travel, buy the whatever it is that you want to buy, the bigger the bigger homes or the cars or whatever, And most people say, I don't know because I want to leave it. Well, guess what? When you die and you give it to your kids, you know what your kids are doing? They're buying the bigger homes. They're going to the country clubs.
They're spending it.
Yeah, exactly. So don't give them any of your assets.
Right.
Don't give your kids your assets. And I know that sounds contradictory, but don't do it. If you're going to give them something, give them life insurance. Because life insurance, you pay pennies on the dollars for. You know, if you have $1 million,
yeah,
and said I want to give that to my kids, and you know that $300,000 of it is going to go to the Internal Revenue Service,
right?
Instead, take that portion, put it in life insurance. You'll get the $700,000 to your kids, right?
Right.
And now you still have another $700,000 that you can give to a nonprofit.
Sure.
How impactful is that?
Super impactful.
Absolutely.
Because now they're getting the full amount of what you really intended, and it's almost like we talked about your fixed income and expenses. You know what you can spend for yourself,
right?
But that there's really it's almost like you're giving the same money. Now you're just giving it in a wiser fashion.
Absolutely.
You know, I always used to say I've been in sales for, as many of you know, for a really long time. And one of the things I used to say way back when is justifying whatever I was selling. And the way I did that was it was a cost justification. And I show them side by side. It's like, look, you're spending the same money. Now you're just spending it more wisely because you're getting much more power or leverage for your value return.
Absolutely.
And so now this is we're leveraging that giving strategy from the concept that, quite frankly, I didn't think about.
Yeah. And look, I'm all for paying my taxes, but I sure don't want to give more to the Internal Revenue Service than I need to.
Right.
You know? And if I can do something more with that, then absolutely I want to be able to do that. And I know that I can give not just to my family, I can take care of my family, you know, but I can also give to others that are in need.
Absolutely.
And we tend to think of life insurance just when we get older, but the one thing that gets overlooked is life insurance when we're young.
What do you mean?
So when we're young, we're typically more healthy.
Sure.
Right? We're not dealing with all these things, but health issues can arise later on. One of the largest, the biggest contributor to people going on disability is depression. We don't think about depression as a debilitating illness.
No, I didn't even know that was a...
Absolutely, it is.
I didn't know you can go on disability for that.
I have a client of mine who actually became disabled due to depression at the age of 16.
Oh my goodness.
Luckily, his parents had put in life insurance ahead of time, right? And that life insurance is set at such a young age that they paid, you know, like $10, $8 a month at the time to make sure that he had life insurance. Because guess what? Now he can't get life insurance.
He won't qualify.
Absolutely not.
Because he has this pre-existing condition which changes his ability or her ability to qualify.
Yeah, I have another client who, after her second child, became diagnosed with type 1 diabetes.
Okay.
She no longer qualifies for life insurance whatsoever. She's married. There's 4 kids. They have a house. They have 2 cars that they're paying on.
Yep.
And she can't get life insurance.
Huh.
However, she has a smaller policy that was put in place by her parents when she was just a baby.
Sure.
So if something were to happen, then at least that funeral cost, all those would be covered and paid for.
Sure.
You know, and the new policies that they have now can actually increase as they get older. It's called a guaranteed purchase option or a guaranteed increase option, which allows at specific times for people to, you know, at 22, 25, every 3 years to get additional income. So they get married, it's a qualifying event. They can get more insurance without having to go to the doctor to prove that they're in good health.
So what about, so go back to that scenario with the type 1 diabetes.
Mm-hmm.
So are you saying that if we have a policy in place today,
yep,
and then it's diagnosed, will those opportunity events to upgrade insurance be there then?
It could be, and that's one of the things when you're looking at life insurance, you always want to make sure that you're going over some of those details. Are there options to buy more in the future? Do I have things like a waiver for disability? So if I become disabled, what it says is that the insurance company will pay my premiums from here on out. All those kind of things, you really want to take a close look to see if they're in there, because many times when people go get insurance quotes, one of the things that's done in our industry, unfortunately, to show people better pricing is that instead of showing them at the risk class that they're probably going to get, which is standard,
Sure.
they give them a preferred or a super preferred price, so it lowers the premium.
Right.
And most likely they're not going to get it.
Okay.
And then the other thing that they do is they leave off some of those riders to show a lower premium ahead of time, and then when it's time for you to sign at the end, then they're like, oh, by the way, and then there's upsell. Or you just want to look at it ahead of time.
Sure. And you want to know that those options are available to you. So it's just like anything else. This is financial education, and most people aren't financially educated because they're not talking about money like we talked about in another podcast.
Yeah.
Omar, thank you for this tidbit, and thanks for this episode of Sean Brady Financial Education and Money Podcast.
My pleasure.
And we'll see the rest of you guys out on social media.